Just as one crisis settles, another begins, the US-China trade talks were just starting to show signs of progress, and then new tensions erupted in the Middle East. Here's what happened. Israel suddenly launched a surprise strike, targeting dozens of Iran's military and nuclear facilities with a series of airstrikes, igniting a new wave of conflict in the Middle East. As the news spread, market risk of sentiment surged sharply, safe haven demand spiked, gold and crude oil prices skyrocketed in response, surging across the board. And after the Asia Pacific markets opened in the morning, they also tumbled sharply. US futures were also sold off in the evening and fell significantly. Prices dropped. Given the current situation, barring surprises, the three major US indices are likely to open lower under pressure, and the odds of closing down are quite high, according to sources familiar with the matter. Israel may be planning to launch multiple rounds of attacks on Iran. These strikes could last a full week, so this situation is far from over. It's still unfolding, so in the short term, the market will likely continue to feel the impact. In fact, yesterday, the Trump administration ordered the U.S. military to withdraw from Iraq and began evacuating some military families. So essentially, the US had already signaled to Israel that it might carry out this attack. What should we be paying close attention to? At this moment, the key focus should be on the price movement of crude oil products. After this event broke out, the most direct impact will be on the future trend of crude oil. Why are we focusing so much on crude oil product prices? Because after Trump took office, he set a clear political objective to bring down oil prices. And why lower oil prices? Because crude oil is a major raw material for most industrial products and also a key transportation cost. Trump aimed to reduce inflation by driving down oil product prices. So what's his true goal? It's actually to use falling oil prices to then bring down US inflation levels. That's why domestically he's been promoting energy development, tapping into abundant shale oil reserves to push oil product prices lower. Internationally, Trump also took action. He worked with Middle Eastern partners to boost oil production together and bring down international crude oil prices. Under Trump's policy efforts, the results have been very clear. Crude oil prices dropped from a high of $79.39 when he took office to a low of $55.12. That's a sharp decline, a drop of 30%. The effect has indeed been quite significant. Over the past 2 months, the cooling of US inflation has largely been thanks to Trump's actions. If Iran blocks the Strait of Hormuz, causing a supply demand imbalance in oil supply, a drop in supply will push oil prices even higher. In the Middle East, they may use high oil prices as retaliation, and with July's inflation data coming soon, it's certain that if oil prices surge sharply, inflation could rise with it. That means July's inflation numbers may be affected. So if crude oil prices remain elevated, it will significantly affect the Fed's pace of future rate cuts. Previously, especially with the improvement in unemployment rates and inflation data also falling short of expectations, things were clearly slowing down. So everything was heading in a positive direction. But if inflation data rebounds again and starts rising again, then the Fed's plan to cut rates will definitely be impacted. The market originally had strong expectations for Fed rate cuts. That outlook was very strong. It could have boosted the market, especially now as the S&P 500 and Nasdaq indexes approach a critical breakout point. If they break through successfully and hit new highs, it would lift the market. That's what the market really wants. That's the outcome everyone hopes for. But now this situation definitely adds pressure to the market. No matter what, it will have some impact. So looking at the S&P 500 and Nasdaq trends now, we can see they are starting to hesitate. The MACD indicator clearly shows a loss of momentum. The upward trend is clearly weakening, but there's one positive sign. Compared to the S&P 500, the Nasdaq shows something that really stands out. And that is on this day, Thursday of this week. During the trading session, the Nasdaq had a surge in volume. That volume spike is a very bullish signal because it's happening at a critical moment and at a key resistance level, a breakout zone. There's clearly pressure here. So at this level, to break through resistance, volume is needed as support. Without volume, even a breakout to new highs could easily fail to sustain. It might not go far. It could quickly fall back. But with solid volume support, the breakout move becomes more stable and sustainable. It becomes more reliable. Once the breakout is confirmed, the trend becomes more solid, and the market will view it more positively. So, this volume expansion is definitely a bullish signal, but we shouldn't misstand it. It's not that after hitting resistance, there was a wave of selling that caused the volume to rise. Why shouldn't we interpret it this way? Because if you look at the intraday chart, we can see that on Thursday, it closed higher overall. The volume increased along with the rise. So it wasn't because of heavy selling at the top. Also, for breakout at such a key level, strong volume is essential. And this volume was clearly double that of the previous sessions. It was a significant increase. That's a positive signal. So we're also looking forward to how the Nasdaq will respond next. The chances of an upward move are very high. From a technical perspective, this position really needs to move higher. If it doesn't move up, the MACD indicator will remain stuck in this weakening phase. It won't recover properly. Only by pushing higher can the MACD break out to new highs along with the price. That would allow for a proper recovery, and the chances of a successful breakout would be higher, much higher. If it starts hesitating again here and pulls back, that could hurt market sentiment, especially since it's just shy of the previous high. So now is not the time for the market to lose confidence. Even though new uncertainties have emerged fundamentally, we can still maintain a bullish sentiment going forward because the three major indexes are not showing any signs of topping out or reversing trend just yet. From a technical standpoint, if we look at the analysis, there's no clear pattern yet showing a top has been reached or that a pullback is about to happen. That pattern hasn't formed. So for now, we're still maintaining a bullish view. We're staying optimistic. That's why, given the current conditions, we can afford to be a bit more optimistic. Now let's talk about individual stock opportunities, especially Tesla. For those of you following Tesla, you will notice recently its rebound has been very strong. Very strong. A lot of people have noticed something interesting. On that particular day when it dropped, it was quickly put back up in a very strong rebound. It recovered its losses. So then why did we see such a strong rebound? Because Tesla's executives recently released a video showing a road test of its autonomous robotaxi project. Once that video was out, it signaled Tesla is moving forward with rolling out its robotaxi service. And it suggests the project is entering the final stage since testing is already happening on the roads. Now, will this project really be implemented? Will it actually launch? Well, this has sparked a wave of market optimism, and in the short term, it lifted Tesla stock, quickly driving the price back up. But at the same time, an Iranian analyst downgraded Tesla's stock rating. The rating was cut from a bullish buy to a cautious hold. And the reason? One of the reasons is the dispute between President Trump and Elon Musk. That public clash clearly had an effect. Plus, the federal EV tax credit is about to expire. That could further dampen consumer demand for Tesla vehicles. This is a short term headwind. And technically speaking, we can see it too. In fact, we've pointed this out before as we previously analyzed. Tesla's current chart clearly shows an inverse head and shoulders pattern, a classic reversal signal, and it has already broken through the neckline. So in the short term, even if it tops out, it's hard to immediately reverse that bullish setup. To undo that pattern wouldn't be easy short term. Given the current overall market sentiment, which isn't strongly bullish or enthusiastic, it's difficult for Tesla to gather enough momentum to fully reverse that chart pattern. And for Tesla, there are both bullish and bearish factors at play, so the situation has become more complex, and we can clearly sense that from the stock price action. Even though it rallied strongly in the past couple of days, it ran into resistance around this zone, and there's already a clear sign of pullback. MACD here has also shows a bearish crossover. The buying momentum is weakening, while bearish momentum has started to emerge. It's very likely to head lower again. It didn't use that sharp rally to break through resistance and stay above it. It failed to hold that level. It couldn't do it. So clearly this area is facing strong selling pressure, and that's why the stock pulled back. This signals a short-term bearish setup. We're likely to see more downside, but Tesla's stock might struggle in the near term. The odds of continuing higher are not great right now. But looking ahead, the market still has confidence in its future. Looking at the long term, Tesla still holds tremendous appeal. That's because of the upcoming Optimus robot and autonomous taxi program. Their testing and results will become major long term drivers for Tesla's stock price. So, in the short term, it's under pressure. The stock price is currently facing downside pressure. But over the long run, the market still acknowledges Tesla's potential, especially with its robot project and autonomous taxi plans. As for the autonomous taxi initiative, following the release of its test video on November 20th, larger scale testing will follow. There's a plan in place, and according to that plan, during the early testing phase, 10 to 20 autonomous taxis will be rolled out. And based on the test results, they will decide whether to scale up. This plan has gained strong recognition from the market, so Tesla's future still holds massive potential. This outlook will ultimately be reflected in its stock price. But what should we pay attention to in the near term? Recently, Tesla's technical setup hasn't been ideal because it hasn't effectively broken through this resistance level. We need to wait for a clear signal. Once this risk signal is removed, that is, on the day it breaks above this key resistance area and holds above it. Only after it breaks out and holds can we then believe that the bullish setup has truly opened up. Right now, the market overall is still quite worried. Israel's airstrike on Iran has led some investors to believe that in the stock market, bears might take this chance to force out bulls, especially those who lack position control, have no hedges in place, and are mentally unprepared. These bulls are likely to exit the market now. So at the moment, Tesla hasn't shown a clear buying opportunity. And in fact, the short-term downside risk remains high unless it can clearly break through this resistance zone. And after the breakout, pull back and hold that level. Only then would the upside setup be confirmed. So for those watching Tesla closely, you might want to stay on the sidelines for now. Don't rush into a position. Wait for a clear signal to emerge. That's all of our brief analysis of Tesla. If you have different views or questions you didn't quite understand, feel free to leave a comment. Let's discuss it together in the comment section.